All right, so the market's up big, it's down big. It is hard to really figure out what's going on a day-to-day basis. And I think that that's a fool's game, right? I think the most important thing that investors should be focused on is really what is working in this environment, right? When stocks are down big, who likely benefits? What groups of stocks actually benefit? And I believe it's dividend growth and companies that continue to grow their dividends year after year. When stock prices are low, you can buy more shares with those dividends. And we're going to go through a couple of examples to show you what I mean, but think about it logically. Okay, if you're new to investing and you don't know what a dividend is, right? Well, if you own a share of stock, what do you own? You own a little piece of equity in that company, right? And the idea is you think that they're going to make money in the future. That's why you invest in them, right? Because you're paying for future earnings. Well, some of these companies, they make so much money, and as a kiss, as like a benefit to an investor, a shareholder, they will kick back a little bit of their earnings as a dividend, right? So you'll actually earn some income by holding the stock. Now, the cool thing is some people don't focus on dividends. And I think that's a huge mistake because you can use that dividend income and reinvest it into the stock. You know, sometimes you're like, I don't have any more money that I want to be, putting into a stock. Well, you can use dividends. And I'm going to show you why over time, dividends can really explode your returns. Now, it's going to take a long time, but it should drive home the point that I think it's a mistake if you're a long-term investor to not be reinvesting your dividends. So let's go ahead and get into a few examples. All right, so this is a cool website. I really like it. It's easy to get to. It's called dividendchannel.com. And then they have this DRIP returns calculator. And DRIP, is for dividend reinvestment plan, okay? And what you can do here is you can put in any stock here, and you can put the start date, end date, and then you can chart what 10K would look like invested. So we're going to go through 3 examples today. The first one we're going to be looking at is Home Depot, HD. We're going to be looking at how much the stock has grown since 1995 to 2022. Then we are going to look at Microsoft, big tech name, right, that everyone knows. And then finally, we are going to look at Exxon Mobil. So let's go ahead and do that now. All right, so here is where the magic happens. So I showed you how we input everything into that website, but here is what the spit out looks like, okay? And we're gonna look at Home Depot, right? And we're gonna go back from 1995 all the way to 2022, right? Crazy, right? I've owned this stock for, I don't know how many years, maybe like 5 years, something like that. I wish I had owned it for longer, and here is why, okay? So the top chart, that's telling you what the return would be if you reinvested your dividends quarter after quarter with Home Depot. And so a $10,000 investment grew to $588,000. But here is the magic of dividend reinvesting, right? So you can see here, the start price was like just under 10 bucks. And then the end price is 365 bucks. Your starting shares, right, for 10,000 bucks is going to be right around 1,022 shares. Okay. Now look at this. Your ending shares is 1,611 shares. That is from compounding and buying, right, more shares with the dividends that you got paid from Home Depot. Okay. So look at this. Dividends reinvested per share over 42 bucks. Okay. This is over a long period. Look at the total return, over 5,777%, okay? And your average annual total return is 16.6%, okay? But right here, what do we see? This is what it looks like if you don't reinvest your dividends, right? You just take your dividends and you let them sit in your brokerage account, okay? And they accumulate. You're not buying shares with them. Well, your 10,000, it still grew to a respectable $417,000. I mean, nobody's going to be upset about that. But look, the total return is only, and I say that, silly, right? 4,066%. So what was left on the table is an additional 1,700%. And that's huge, right? And so you ask yourself, what's the difference in a 15.1% annualized return versus 16.6? It can be hundreds of thousands of dollars. And so I'm saying all of this because when the market is down, right, and stocks are down, having stocks that pay dividends, stable dividends, great companies, right, like a Home Depot, you can buy more shares effectively cheaper, right, because of lower prices. And that's what you want when you're a dividend reinvestor. Let's do Microsoft, which is another name I think I've owned for like 5 years. Great name. Let's go all the way back to 1995 to 2022. 10 grand turned into $848,000. Okay. Reinvesting your dividends, you got an 18.22% average annual return. But if you didn't invest those dividends, reinvest those dividends, it was only 16.5. And yeah, 10 grand did turn to 577 G's. But wouldn't it be nice to turn it into 848 G's? Yeah. So look, the point is dividends over time can really, really compound. Okay. It is the magic. It's the eighth wonder of the world, they say. Let's do one more. And I'm going to try and drive this one home because everyone knows over the past few years, what was the worst performing sector? It was energy, right? Literally, there were so many people out there saying that they were going to zero, all these companies, and they weren't ever going to be able to pay their dividends and all that blah, blah, blah. But check this out. This is ExxonMobil, right? And I remember this as a kid. Just about everybody wanted to work at ExxonMobil because the stock price just always went up. But look at it from 1995 to 2022, and you can see that the total return with dividends is over 900%. Compared to not reinvesting your dividends, right? 620%. Okay. So with dividends, just over 9% annualized. Without it, 7.73. Now, I'm bringing this up because ExxonMobil has been down for a long time. Okay. It's been down for a number of years. So the person that was reinvesting those dividends, they're able to buy more shares because the share price is low. And so they get this really big gearing effect, this compound effect, whenever energy stocks eventually go back up. And so this is what is being left on the table. But again, it takes years and years and years before you start to see the disparity of reinvesting dividends and not. All right, so what's the point? The point is yeah, stocks are down and people are grumpy and they think that we're going into this nasty bear market. But as I've shown you over decades, right? And you look at Home Depot, Microsoft, ExxonMobil, right? Eventually, the great companies are going to continue to be great. And those that are paying out dividends when their prices are low, it can really benefit you if you are reinvesting those dividends. And in fact, when stocks are down big, that's probably the biggest opportunity going forward. And a lot of people, they don't think that way because they think about what's going on now. But, you got to think forward, Are these stocks going to go up over time? Are they going to likely make more money over time? Is the stock market going to be higher 10, 20 years from now? I think so. Based on history, that's just what it does, right? The economy continues to grow. So listen, you guys hang in there. There are some great opportunities. Just remember, don't be getting sucked into all the big bear stories and all of that. There are great companies that are on sale right now. I think you should use that to your advantage. I'll see you next time.